if you get out of that spreadsheet mentality and think like everyone should just own index funds all the time, and you think behaviorally, some people just need to scratch that itch. They want to watch CNBC, they want to pick individual stocks, they want to talk about it with their friends or their coworkers or whoever because they put money into this company back in the day when it was $5, now it's $100 or whatever it is. But I think you just have to portion control, basically. It's like a diet. So I think if you need to scratch that itch and you want to take 5% of your portfolio or 10% or 15, whatever, and then that allows you to leave the rest of your portfolio alone, there's nothing wrong with that. Having a fund portfolio or a speculative portfolio where I'm going to buy crypto and penny stocks and I'm going to speculate my face off. I'm going to buy options. And I think that's okay as long as that allows you to leave the other stuff alone. And I think some people draw a hard line where when we talk to our clients and they want to do that, I don't think you need to necessarily stop them from doing that, because if it means they're going to be not worrying about the rest of their portfolio and this long-term stuff that's more rules-based and process-based, I think that there is some room for that. Now, obviously, where you get in trouble is, you said in 2020, Jason Zweig had this stat that like from the bottom in March 2020 over the next 12 months, something like 96% of all companies in the Russell 3000 were positive. And it was that's like the highest batting percentage that, we've ever had. And I think it just felt way too easy for people I'm going to pick this company because I know this company, and this company the stock is going to do well. And it doesn't always work like that, where good stock equals good company. Maybe over the long term, but especially over the short term, good company could mean really bad stock because it's way overpriced and everyone already knows that it's a good company. And so I think that's the problem for a lot of people is they get good results in a short time period, and they think, why would I need to do this other stuff with my 401k? Why don't I just put it all, what I'm doing in my brokerage account, and pick stocks? And I think you just have to have the right mindset of, I'm going to do it with a little piece here. And the great thing is, I think if you give yourself a couple of years, you see that smaller piece, your 10% of your portfolio is underperforming. And I think even if that happens, you can say, okay, that kind of shows me why I'm sticking with this long-term piece over here and not messing with it.
I couldn't agree more with you. And as an advisor, we're always trying to not just create a portfolio that is going to be the best for people's needs, their risks, objectives. Anytime you can give someone sort of a behavioral pass that allows them to stay the course with what you're trying to do, I'm usually a fan of that. But one thing that strikes me, and maybe you experienced this as an institutional manager, like you mentioned, picking active managers or hedge funds who would do better than the rest. There really is no such thing as a perfect portfolio. And you can run things through optimizers, and everybody wants to think that there is some sort of perfect way to tweak the portfolio here or there, or to know because of valuations or lower expected returns or higher expected returns that there's an obvious solution in advance. And with hindsight, sure. But, even if we did know with certainty the perfect portfolio for the next 20 years, I'm not even sure people could stick with it. Whatever gyrations happened over a 10 or 20 or even 5-year period.
My friend Wes Gray from Alpha Architect wrote this piece 5 or 6 years ago called Even God Would Get Fired as an Active Investor. And he went back to like the 20s and he put the stock market, the S&P 500 into deciles. And he took over a 5-year period, like the top decile of stocks for every 5-year period. So the top 10%, and the returns were like 30% a year. It was something ridiculous because you pick the best stocks over the next 5 years, it in advance. But if you look at the drawdown profile, during the Great Depression, it still lost like 80%, and it had all these 30 to 40 to 50% drawdowns, because you would have had to hold those stocks over 5 years. And his point was, even if you know in advance what the best portfolio is going to be, a lot of people wouldn't be able to stick with it. And I think that's why it's important for investors to not only define like what it is you're going to invest in, but what it is you won't invest in. So Josh Brown, who I work with, always has this analogy of, as an advisor, you're a bouncer. And so you're holding the line, and there's a lot of stuff that you just won't let in. And even if it could be a good investment opportunity for someone else, it doesn't necessarily have to be for you, because maybe it doesn't complement what's already in your portfolio or your plan. And even if it has good income or good total return, expected returns, if you just say no right away, I think it just saves you a lot of time and heartache, just from understanding that you don't have to pay attention to it. You don't have to waste a bunch of time performing due diligence. If you know that I'm going to invest in A, B, and C, but D, E, and F are just off my plate completely. I'm not going to invest in this stuff because I just don't want to. It's not part of my risk appetite or whatever it is. It's not going to be part of my portfolio. I think that just makes things easier if you just swat some things aside right away and say no a lot quicker than worrying. Because for individual investors, frankly, we've never had a better environment to invest in, right? You have low cost options for anything you could ever imagine. I was talking to a colleague the other day. Jim O'Shaughnessy wrote this book, What Works on Wall Street. It's a classic. And I remember reading it in the early 2000s, and it was talking about using rules-based approach to buy 50 stocks that are undervalued and how great those returns would be. Just a value stock portfolio. And thinking at the time, there's no way I could afford to buy 50 stocks and rebalance it quarterly because it costs $20 for every trade, and I don't have enough money to do that. But now you can do that with a push of a button on an ETF. The ETF probably costs 25 basis points, and it's free to trade, right? So there's been so many advances for individual investors. The problem is there's so many options now that you're constantly tempted to invest a little bit here and a little bit here and a little bit here. And then you have this mishmash of, it's like a buffet where it's like, what is this even doing? What's the whole point here of this portfolio? So you don't have like a plan in place or an asset allocation in place that sort of brings it all together. Then what's the point of having all those options?